Okay, so now that you've seen the checklist, I think it's important we show you a trade page and see how these rules actually play out in reality. So let's go to a trade page. This is one of the softwares I use. And we're going to start with our rules up at the top here. Number one being as close to 45 days to expiration as possible. And if you look here, here's an option chain, different months, weeklies, etc. And here in parentheses is the days to expiration. So I think you can see here 46 is going to be the closest one to 45 we can get. So if we're going to make a trade, we originally start right here. This is the option chain we're going to use. 46 days because that meets rule number one, as close to 45 days as possible. As far as volatility rank, I can't show it to you on this trade page, but again, this is a preference, not a requirement. We're always looking for volatility rank above 50, but it's not required. We can absolutely sell puts in stocks with volatility ranks lower than 50, but that's just a preference. We're always going to look at that first and compare two stocks. If they're both stocks we're looking to get into, obviously we're going to go with the one with the higher volatility rank. So let's come down here, and we're on the trade page, and you'll see here is just a number of strikes. And let's go up to our golden rule up here, which was our initial rule when we trade, which is our strike price always has to be less than our stock price when we're selling puts. So if that's the case, if the stock price here is at 138.58, immediately we know we can't sell any of these strikes down here because they are all above the stock price. 139 is above 138.58. So everything from here down, 139 and above, are strikes we would never sell if we're selling puts. So that gets us through our golden rule. Now what do I mean by this? Because I'm sure everybody was confused when you first saw inverse delta equals POP, out of the money percent, pick your win percentage. Holy smokes, that's a mouthful. Let me show it to you and I think it'll make a lot more sense. So, since most platforms don't necessarily show you the probability of out of the money, which actually means your chance of winning, delta is something that most platforms, if not all of them, have. So in order to work out your chance of winning, if you don't have this as a potential column on your platform, it's really easy. When I say inverse delta, all I mean is out of 100. So if we see a 7 delta, all I want you to do is subtract it from 100, and that'll give you a quick and easy version of POP, or my chance of making money. So if I subtract 7 from 100, I should be at roughly 93% chance of making money. And here you see, pretty darn close, right? As a shortcut, that works pretty well. If I were to pick the 13 delta, if I subtract it from 100, I should get about an 87% chance of making money, and you see, pretty darn close. So delta, inverse delta, is a nice easy shorthand to tell you your chances, your POP, your probability of making at least $1 profit on this trade. So that's what I mean when I say inverse delta. It's delta out of 100, so you're just going to subtract it from 100, gives you your POP, which is also synonymous with out of the money percent, etc., your win percentage. So when I say pick your win percentage, I think you can see now how that can be done. If I want to have a 90% chance of making money, I'm going to sell the 10 delta, right? That's how I pick my win percentage. If I want to have an 80% chance of making money, I'm going to sell the roughly 20 delta. And you see, again, it gives me, roughly that 80% chance of making money. Again, it's a shortcut, so it's going to be close. So that's how we pick our win percentage when we sell puts. All we do is we look at the delta, subtract it from 100, and that'll give us our chance of making money. We get to pick our win percentage. Hey, that's pretty cool, right? You want to know what your chances of making money on this trade are? Real simple. Take your delta, subtract it from 100. Done. It's that simple. So that leads us to this, which says higher POP, lower income. So what does that mean? Well, let's look at this. If the stock is down here roughly, it's at 138.58, so it's right at about this strike. Let's say that's roughly the at the money strike. Obviously, the further you go away from the strike, the further you are away, the better your chance of making money, right? Obviously, if you sell the 124 put, there's a much better chance that that's a winner than if you sold the 137 put. Obviously, you're $14 away over here, and here you're like just over $1 away. So what's the trade-off? Why wouldn't I always sell things that are just way out of the money, and with a huge chance of success? Well, that's because the higher the POP, the lower the income. So if you see here, if I sell the strike directly below where the stock is, or just $1.50 below, you can see I'm going to sell it for roughly $2 and let's say 20 cents is the mid price. And when I do that, you'll see the delta is 41, which should tell you there's a roughly 59% chance that I make money on this trade. So there's a low POP, there's a low chance of making money, but there's a much more money to be made. Again, lower POP, higher income. So let's go with what I have up there, which is the higher POP. So higher POP would be way down here. There's a roughly 93% chance of making money. Higher POP, lower income. Of course, look, I can only sell this thing for about 32 cents, let's say mid-price. That's the trade-off when you play the shorting puts game, when you sell puts. The farther away you are, the higher your chance of making money, the lower amount of money that you're going to be able to make. So it becomes a risk-reward thing. What is your risk tolerance? How much are you willing to risk, right? Because you can pick any number in here you want. If you're risky and you don't mind getting put the stock, but you're willing to take a chance and make some money, you might sell the 138 put and collect about 260 or somewhere in that range. Now that's about a 50-50 shot, so there's a 50-50 chance you're going to get stuck with this stock. But if you don't, look at that, you're going to collect 260 bucks in the next 46 days. Whereas way down here, if I sell the 124 put, sure, there's a 93% chance that I can make money, but the money is very little. There's only maybe about $32 I can make max if I do this thing. Which also leads into, there's a certain point where it's just not worth it. If you sell a 99% chance of making money, as I'll show you on the live platform, you might only be able to make $2 or $3. At that point, the commission costs alone are going to be too great. So that's why we have to decide on which POP or which delta we're going to use. And finally, cost basis, you know how that works now. You know all we're going to do is take our strike price and subtract out our credit received to work that out, and that's the final step. So we know if we do get put stock, what's the price we're going to get stuck with it at. Down here, you're going to get put stock at roughly 123.70 if things go against you. So you don't really want the stock, but if you do get stuck with it, you're way down here with the stock being at 138.58, 46 days. Whereas over here, if we get put the stock, it's about, let's say, 260 tacked on. We'll make it real simple and just say if we get put the stock here, it's roughly 138.60. Knock off 260, we're at about, what's that, 136 would be about the price we get stuck with it at if we get put the stock. And that's, again, cost basis, break even is important, because if you're going to be forced to buy stock, you want to make sure you can afford to buy stock at these prices if you play this game.